Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CMS Energy Corporation Annual Report. CMS Energy Corporation offers a wide range of businesses and services to its customers in Michigan. At the core of their operations are two primary segments: electric utility and gas utility. The electric utility segment provides electricity generation, purchase, distribution, and sale through various sources such as coal, wind, gas, renewable energy, oil, and nuclear power. Their extensive network includes high-voltage distribution lines, substations, and underground lines that cater to over 1.9 million electric customers. In addition to electricity services, the company also offers gas utility services, which involve the purchase, transmission, storage, distribution, and sale of natural gas. This segment has a vast infrastructure of transmission lines, gas storage fields, distribution mains, and compressor stations that serve approximately 1.8 million gas customers. The Northstar Clean Energy segment is dedicated to independent power production and marketing, focusing on renewable energy development and operation. While this segment does not directly provide services to residential or commercial customers, it plays a crucial role in the company's overall strategy of promoting clean energy solutions. Overall, CMS Energy Corporation provides a comprehensive range of businesses and services that cater to various customer needs, including electricity generation, distribution, and sale, as well as natural gas purchase, transmission, storage, distribution, and sale. CMS Energy Corp's stock price has experienced a modest increase of over 9% in the past year, driven by several key news events. One major contributor was the company's strong financial results for 2025, which exceeded expectations due to the success of its Northstar Clean Energy unit. This led to an upward revision of guidance for 2026, instilling investor confidence. Additionally, CMS Energy announced a significant increase in its dividend payout, marking the 20th consecutive annual rise. The company also unveiled a substantial 5-year investment plan totaling $24 billion, demonstrating its commitment to long-term growth and clean energy initiatives. The approval of a 20-year renewable energy plan and a data center tariff in November 2025 further boosted investor sentiment. These developments are expected to facilitate significant customer investment opportunities in solar and wind over the next decade, while also supporting growth in emerging markets. Overall, these positive news events have contributed to CMS Energy Corp's stock price increase, reflecting strong market sentiment and anticipation of future growth in clean energy and emerging markets. CMS Energy Corporation market capitalization of $22 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that CMS Energy Corporation holds a significant advantage in their industry. CMS Energy Corporation trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 2.53 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 76% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.09%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for CMS Energy can be attributed to several key factors. Regulatory assets, unbilled revenues, and alternative programs play a significant role in driving revenue growth. The electric utility segment is a substantial contributor to the company's revenue, with residential, commercial, and industrial segments generating significant income. Clean energy revenue is also a growing component of the company's revenue, driven by renewable generation and marketing of independent power production. Leasing income and financing income are additional contributors to the company's revenue. On the other hand, regulatory liabilities can negatively impact revenue growth. Overall, CMS Energy's financial performance is influenced by these various drivers, which must be carefully managed to ensure sustained revenue growth. The net income of the company experienced a significant increase from 2023 to 2025. In 2024, it rose by $141 million compared to 2023, and then increased further by $68 million in 2025. This growth can be attributed to several factors, including electric rate increases, gas rate hikes, lower coal-fueled generation costs, and other positive changes. The profit margins of the company's utilities also saw a notable increase during this period. Electric utility profit margins rose by 38% in 2025 compared to 2024, while gas utility profit margins surged by 81%. However, Northstar Clean Energy's profit margins increased by only 8%. Despite these gains, there was a slight decrease in overall profit margins from 14% to 13.9% between 2024 and 2025. This minor decline can be attributed to the increase in comprehensive income over net income, which rose by 107.6% in 2025 compared to 106.8% in 2024. The reasons for the net income increase are largely due to rate hikes and cost reductions. The electric rate increase contributed $210 million to the growth, while gas rate increases added $71 million. Lower coal-fueled generation costs also played a role, contributing $26 million. Other positive changes accounted for an additional $119 million. Overall, the company's net income and profit margins experienced significant growth between 2023 and 2025, driven by rate hikes, cost reductions, and other factors. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, CMS Energy and Consumers are both expected to produce significant amounts of positive operating cash flow by 2025. Specifically, the values for 2025 are $2,235 million and $2,238 million respectively. This trend is further confirmed on page 100, where it is stated that the company will continue to generate positive operating cash flow in 2025 with a value of $2,235 million. These figures demonstrate the company's financial stability and its ability to maintain a healthy cash position. The debt level and interest expenses of CMS Energy and Consumers have undergone significant changes. For CMS Energy, the total long-term debt has increased by 17% from $15,194 million to $17,807 million. However, despite this increase, the company's interest expenses have actually decreased from $5,025 million to $6,285 million. This suggests that the company may be benefiting from lower interest rates or more favorable debt terms. In contrast, Consumers' total long-term debt has increased by 164% from $489 million to $1,289 million. However, this increase is largely due to a one-time adjustment in 2025. On an annual basis, Consumers' debt level has actually decreased by 163%. The company's interest expenses have also remained relatively stable, with no significant changes mentioned. Overall, while both companies have experienced changes in their debt levels and interest expenses, the magnitude of these changes varies significantly between CMS Energy and Consumers. Management is committed to a sustainable future for the company, with goals of achieving 60% renewable energy by 2035 and 100% clean energy by 2040. This commitment is reflected in various initiatives, including investing in grid hardening, distribution capacity, and automation to improve reliability, as well as focusing on digital transformation and implementing lean operating systems. The company also expects significant capital investment over the next 5 years, with a focus on electric generation, distribution systems, and gas infrastructure upgrades. This investment is expected to support growth in demand for energy, with weather-normalized electric deliveries projected to increase over the next 5 years. In addition to its commitment to sustainability, management is prioritizing customer affordability and economic development, seeking to reduce overall rates while continuing to reduce carbon footprint from own generation. The company also plans to spend $24.1 billion on capital expenditures through 2030, with a focus on electric generation, distribution systems, and gas infrastructure upgrades. Overall, the company's strategy is centered around delivering safe, reliable, affordable, clean, and equitable energy to customers while prioritizing sustainability and customer affordability. Acquisitions and divestitures. A summary of CMS Energy's strategic moves. CMS Energy has been actively engaged in strategic acquisitions and divestitures to shape its portfolio and improve operational efficiency. On the acquisition front, the company has made significant investments in electric generation and infrastructure. Notably, it acquired all outstanding shares of consumers, constructed or acquired new electric generation capacity, and retired outdated coal-fueled generating units. The company also obtained approval to retire another large generating unit, J.H. Campbell, by 2025. Furthermore, CMS Energy issued securitization bonds to finance the recovery and return on its DE. CARN units. Additionally, it sold membership interests in various VIs, variable interest entities, to tax equity investors. In terms of divestitures, CMS Energy has been actively shedding non-core assets. The company sold off specified assets with provisions for retaining pre-existing liabilities and indemnifying buyers against certain risks. It also assumed indemnity obligations related to ownership interests in facilities involving tax equity financing. Furthermore, the company reversed a $13 million non-Michigan reserve due to its plan to divest immaterial business activities outside of Michigan. Overall, CMS Energy's acquisitions and divestitures reflect its efforts to optimize its portfolio, improve operational efficiency, and reduce liabilities. By shedding non-core assets and investing in strategic initiatives, the company aims to drive growth and profitability in the long term. The company's financial history reveals a consistent pattern of dividend payments and share buybacks. In terms of dividends, CMS Energy has received significant amounts from consumers, including $898 million in one instance. Additionally, the company has paid out preferred stock dividends totaling $30 million over 2 years. Furthermore, it has made substantial dividend payments, with figures ranging from $579 million to $663 million over 3 consecutive years. Regarding share buybacks, CMS Energy has employed an indirect method through consumers' ability to acquire its own shares from the company. The company also has outstanding forward contracts to sell up to $1 billion in shares. Moreover, a specific instance of a share buyback is documented, with a total amount of $1,094 paid out under a secured revolving credit facility. Concerns about supply chain disruption and inventory buildup have been raised in various contexts. On one hand, supply chain disruptions pose a significant risk to businesses due to factors such as extreme weather events and cyber incidents affecting natural gas pipeline infrastructure. This can lead to global supply chain disruptions that may hinder the ability of companies to implement their plans. On the other hand, there are also concerns about inventory buildup, particularly with regards to gas inventory levels. This suggests that companies may be holding onto excess stock due to uncertainty or disruption in the supply chain, which can have its own set of problems such as storage costs and potential obsolescence. That concludes the financial summary for CMS Energy Corporation. Feel free to comment below, and I will be happy to answer them when possible.